uncertainty is kind of the word for the year. There's no indication that they're going to invest more, and then there was some indication that they're going to invest less. CEOs all over the world are very uncertain about geopolitics, policy, regulation in the markets that they operate in. They say it's disruptive in a negative way. We've priced in one in March, and that would be 25 basis points, and then another in June. And I think that's probably going to be it, or potentially even zero. It really depends on where inflation goes and if the labor market continues to hold up.
Pleased to welcome to the show Dana Peterson. She is a chief economist, leader of the Economy Strategy and Finance Center at the Conference Board. The Conference Board puts out leading economic indicators for the U.S. and global economies. They're widely followed indicators used by economists, analysts, and hedge fund managers alike. And we'll talk about also their surveys that they've conducted, focusing today on C-suite, C-level executive surveys that they've recently released. Welcome to the show, Dana. It's very good to host you. Thank you for being here.
Thanks for having me.
Before we get into the CEO surveys themselves, which in themselves are very good leading indicators, some would say, for where the economy is headed, let's talk about what you think should be the primary indicators or indicator, singular, that economists should follow for 2026 to gauge the direction of the economy, focusing on the U.S. first.
Sure, absolutely. I think a lot of it has to do with consumer spending and also consumer confidence. We produce a consumer confidence measure as well as a CEO confidence measure, but CEOs are very interested in knowing what their customers are thinking. And indeed, the outlook is not very good. Many consumers are concerned about business environment over the next 6 months, as well as their own employment opportunities and even their incomes, and certainly finances. When they think about their finances, they're concerned for the future. We've also seen consumers anticipate that interest rates would actually go higher and not lower, which is a challenge, certainly for the housing market. And also consumers expect that they're still going to be saddled with higher prices, elevated prices, even if the rate of price increases is slower.
You've worked on Wall Street before you were involved with the Conference Board. So just give us a sense of what Wall Street follows when making guidance and, I guess, financing decisions, generally speaking.
Absolutely. I mean, number one is the Fed. So
Okay.
whatever the Fed is doing, or they think the Fed is going to do, Wall Street folks tend to pay very close attention to that. But then it's like, well, what is the Fed interested in? The Fed clearly has a dual mandate. One is price stability. The other is maximum employment. And so we know that the Fed has said that they've been pleased with the direction of inflation, getting closer and closer to their 2% target. But they did have and continue to have concerns about the labor market. Although when I look at the labor market over the last 4 or 5 months, we haven't really seen anything different. We're seeing very small payroll gains, which is consistent with not being too far away from which is not inconsistent with being too far away from neutral. And also, when we look at wages, they're still growing at a rapid clip, and very few people are getting laid off. And that's also a reflection of CEOs being uncertain. So they're just holding on to their workers, waiting to see what's going to happen with tariffs, regulation, government spending, and they're just not really hiring. So we do see a little bit of a pileup in people who are finding difficulty finding a new job, but we're not seeing new layoffs. And so I think all of those things suggest that the Fed can probably sit back in January, not touch interest rates, and think about it maybe for March or even June. So I think that's what Wall Street people are really focused on. How does the Fed view the economy?
Even if the unemployment rate doesn't continue to rise up from here, and even if the inflation rate continues to go up, and I will get your outlook on inflation and the unemployment rate in just a bit, Dana, but even if inflation continues to rise, can we still expect a dovish Fed, given that Jerome Powell, current Fed chair, has just put out a bombshell video admitting, or in his opinion, that the only reason he got subpoenaed by the DOJ was because the Fed was asked by the president to lower interest rates and they did not comply. And so he's basically admitting that there was political pressure to lower their interest rate. How far will this political pressure go, even despite the data warning us that inflation will go higher, Dana?
Yes, well, I don't think that the pressure on the Fed will go away. I mean, this is actually nothing new. Since the Federal Reserve System was put into place more than 100 years ago, there was always resistance. Certainly in the middle of last century, the Fed was given much more independence because we've seen that movie before in other countries where uh, central banks did not have independence and they were pressured by politics. So what we're seeing now is not a new phenomenon, but it is quite surprising. And I have a feeling that policymakers, monetary policymakers, will continue to look at the Fed as solely focusing on monetary policy, and that fiscal policy stays in its fiscal policy space, and that they are going to continue to watch the economy, the economic data that are coming out, and make their decisions based upon that, not on any short-term political desires or whims.
Well, we have the CME Fed Watch tool basically telling us that there's not going to be any sort of movement in the Fed funds rate at the next meeting, which is going to be 2 weeks from, 12 days from now exactly. And then further out in the year, the probability gets a little bit higher, but not by much. How many rate cuts can we expect realistically this year, Dana?
We've priced in one in March, and that would be 25 basis points, and then another in June. And I think that's probably going to be it. Two more, or potentially even zero. It really depends on where inflation goes and if the labor market continues to hold up. But if the labor market starts to deteriorate materially, where you see hours falling, also lots of people being let go in key industries that we know haven't already been consolidating, then I think that's going to disturb the Fed, and they probably would go ahead and cut at least twice. But if we don't see that action, the Fed's probably, they may even say we're here, we're at neutral. They already said that they were very close to neutral.
Well, this is the leading economic indicator, the LEI, that the Conference Board publishes. These red horizontal lines are recession signals, and they've been triggered a couple of times now, just in the last couple of years. Specifically, 2024 was the most recent episode, 2025 as well. Why hasn't there been an official NBER designated recession then, Dana?
Sure. I think there are two factors here. Number one is the components of the leading economic indicator. And it works for the components that we've asked it to look at. So basically, it did capture the slump in manufacturing, also the housing weakness. It also looks at the labor market, but it's looking at changes in the leading economic indicator. And so even if the change is coming from a low base, it still picks it up as something negative. And also consumer and CEO confidence over the last few years has been weak, even though we never went into a recession. So that's the first thing. There are other areas of the economy that have done quite well, like services were very strong. And also, when we look at the labor market, other labor market measures, most people are working, and we reached maximum employment, according to the Fed, late last year. And so I don't think we're very far away from it. And so as long as consumers are working, they have incomes, and they feel generally good, they will continue to spend. But again, we did have big shocks in 2025 in terms of changes in taxes, as well as changes in government spending for consumers, and the tariffs, which do feed through to inflation. But nonetheless, the data we have so far, which isn't much, is that yes, consumer spending has slowed a bit, but consumers are still getting out there.
Before we continue with the video, let's talk about today's sponsor, Delete Me. Most New Year's resolutions fail because they require constant effort, but protecting your online privacy doesn't have to. Your personal information, like your name, address, and phone number, is often collected and sold by data broker sites. That's why I use Delete Me, a service that helps reduce that exposure. It takes about 5 minutes to set up, and then they handle the work for you all year. They scan for where your information appears and submit removal requests to hundreds of broker sites. I've been using it for more than a year now, and they have reviewed over 325 listings to see if any data brokers have my personal information, and they continue to check to make sure it stays off. Go to joindeleteme.com/DavidLin, link down below, or scan the QR code here and use DavidLin, that's my promo code, at checkout to get 20% off all consumer plans. Take control of your online privacy today before somebody else does. Now back to the video. Okay, consumers, especially, I'm guessing the wealthier consumers at the higher income tercile, those are the people spending, not the rest of the population. Is it true that we actually have a K-shaped economy, Dana? Is that what you're observing?
There's always a K-shaped economy, even during the
Okay, sure.
during the great financial crisis and during the pandemic. You always have a subset of the population who have more wealth, um, or just more income, and they're going to continue to spend. They're just less conspicuous about it. They'll, not get a logo bag. They'll just get a plain white bag, or they go to Bloomies, they just get the large bag. Consumers who are not as wealthy are definitely still spending. They're just shifting what they're spending on. They're having to prioritize goods and services that they need, like food, housing, utilities. Those are the things that they need. And when they do engage in spending on things that are quite discretionary, they will choose the cheaper option. For example, our consumer confidence survey consistently shows that people will go out to restaurants and they'll stream, but they won't. But the types of restaurants they're going to are cheaper, and they'll stream TV instead of taking the whole family to the movies, which costs more. So consumers are changing their behavior. And you also are seeing people who are just buying fewer things. If they don't need it right now and they don't want to finance it with buy now, pay later or credit cards, then they just kind of pull back.
Let's talk about the CEO survey now, Dana. And before we get into the results, maybe walk us through the history of the survey first. And ultimately, why looking at CEOs and what they think is important when analyzing the economy. And then we'll talk about the results themselves.
Yes, our C-Suite Outlook survey is something that we've been doing for 27 years now, where we canvass CEOs and other members of the C-Suite, plus board members across the globe. And certainly we do deep dives in the US, Europe, and also Asia, including China, Japan, ASEAN, and Australia. And so what we've seen, at least for this year, we just released our survey, is that uncertainty is kind of the word for the year. CEOs all over the world are very uncertain about a number of things: geopolitics, policy, regulation in the markets that they operate in, even structural shifts like fewer people working because people are aging out. And also the biggest thing that many CEOs are focused on, they say the biggest shift is AI. That is a major structural shift. They say it's disruptive. They say it's disruptive in a negative way, but they also see AI as a solution to a lot of their problems. And indeed, they are changing their business models to enable their people and their operations to become more technologically savvy, and also incorporating new technologies like AI to overcome the uncertainty.
The uncertainty last year was mostly surrounding the trade deals that the U.S. had made with the world. Tariff uncertainty. CEOs were uncertain as to how they could expand their business if import duties were to be raised, and they were uncertain as to whether or not these tariffs would be persistent, rather than transitory, as Powell might say. But Dana, what about this year? What are the top causes for uncertainty this year? Is it still tariffs or something else?
Yes, indeed. Uncertainty was number one for economic issues, but second to that was definitely tariffs. Also economic recession and downturns, especially among European and Asian CEOs. So also just uncertainty about governance. With the greening of the global economy, multinational firms have to be focused on sustainability more in certain regions than others. They're also very concerned about politics internally in the markets that they operate in. And moreover, they're very uncertain about how AI is going to impact their businesses. Many of them are trying to get ahead of the curve. And interestingly, the most important human capital issue was what effects will AI have on our people, and how do we prepare them for the next digital age?
I guess you'll find out in the next survey that you do. But geopolitical uncertainty, has that ever popped up in the last year? and especially this year after what happened with Venezuela, talks with disbanding NATO. Has that affected C-level decision making at all, Dana?
Yes, and we actually did ask a question about geopolitics, and what rose to the top was not necessarily conflict, like kinetic conflicts, but certainly political polarization. Also, shifting dynamics in terms of regulation. And there's also, and when we did ask about regional issues, Asia was very much concerned about, well, I would say Japan was very much concerned about a conflagration with China. Other Asian economies were more concerned about the Middle East because many of them are purchasing oil from the Middle East. And in North America, a lot of it was in Western Europe, it was about Eastern Europe. So with the US, it was less about conflict. But again, the survey was done, a little bit before the US and Venezuela situation occurred. And I would imagine that if we asked today, US and North America CEOs, they might actually raise conflict in Latin America or Central America or even in the Arctic as a concern. And the reason why is because it impacts supply chains. You could potentially have to move your ships around conflicts that are going on in the waters. And it also impacts your labor force, not only if you have laborers and operations close to these areas, but also psychologically. And indeed, one thing that was surprising is that CEOs are prioritizing mental health as a focus to invest in, not only for understanding their customers, but also for their workers.
Mental health for their workers, not for themselves.
Correct. Mental health for the workers and also as a societal issue, which also means their customers, kind of understanding the zeitgeist and how they can help not only their customers, but also their workers make sense of everything that's going on and stay focused and productive amid these existential things.
Well, I'm curious how this uncertainty translates to hiring specifically. So we've got CEOs uncertain about uncertainty, and also the second issue, tariffs, that you brought up. Here in the article from the Conference Board cites, they're also uncertain about the ROI of AI spending, which I'll touch on just a bit. So what does this mean for employment overall, Dana?
Well, we did ask them, what are you going to invest in? Or what are you going to do to promote higher profits? And also regarding human capital, what are you going to be doing? And, cutting workers was not high on the list. It was more so investing in our workers. Again, you have these technological changes. It's much more tangible, and customers, whether they be business, B2B or B2C, are using more technology. It's part of their lives. And so businesses are focused on making sure that all their operations are using technology to optimize what they're doing, but also to maximize the capabilities of their workers, to ensure that their workers are ready for this next digital age and that they can accommodate the customers who are demanding things quickly and they want the convenience of things being digital or online.
Did CEOs answer any questions about wages and whether or not they're going to keep wages the same or lower wages this year?
Well, we didn't ask that in our C-Suite Outlook survey, but we have asked that in our quarterly U.S. survey of CEOs. And for the most part, they are still raising wages, but not as aggressively as they had been. So I think that's a function of labor shortages. Indeed, many industries need workers. So that includes the financial sector needing high-end workers, as well as the construction sector, healthcare. All these sectors and along all the different types of occupations, we don't have enough people who are skilled. And that's the other thing. Even in the industries that can tap into a lot of people, the question is, do they have the right skill set? And companies are actually looking to bring on people who are unskilled and actually train them in the areas that they need them to be because they're just that desperate for workers.
And let's talk about AI investments. So that there's a bit of a little bit of a, in my opinion, kind of a contradiction here with what they think and what they're doing. So, according to your survey, their concern exceeds. The Conference Board Service found CEOs worldwide struggling to pin down AI's business value. 33% of CEOs globally say their top AI priority is measuring their ROI. Another article here from the Boston Consulting Group says that 4 out of 5 CEOs are more optimistic about the ROI of their AI investments than they were a year ago. I don't know if they're asking different CEOs, but it certainly looks like AI CapEx is on the rise, even if executives claim they are concerned about ROI, return on investment. So how do you reconcile this kind of, difference here?
Yes, absolutely. Over the last 3 years, we have asked CEOs all over the world, and especially in the US, about AI. And they see great things for AI. They really, many of them even think it's going to increase the bottom line. But the issue is not that they don't want to use AI or they're afraid of it. They just don't know how to measure if it's working. And that's the tough part. It's intangible. And certainly, I mean, you can count hours of how long it takes your workers to do something. For example, we've been able to expedite how we sort through tons of data or even text using AI. We do write our own stuff, of course, but still no one's sitting there counting, right? How many hours did we save? All we can say is, well, last year we did the same thing. It took us 2 weeks, and then we utilized AI, put all of our content in it, asked it to sort it out, and it did it in a minute, right? But again, that's difficult to quantify. But nonetheless, again, CEOs do think that AI is something that is disruptive, but they also see it as a good thing. In fact, we always ask about supply chains, and 3 years in a row, the answer has been we are going to use AI to optimize our supply chains. It continues to be number one. They're also looking at using AI in marketing, not just to ideate things for marketing and communications, but to use AI as a tool. They also are looking at productivity. And like I said, they want to train their employees to use AI, whether it's to help better service their customers or to increase their ability to code things, whatever it is. They are looking at AI as a savior and also a way to really enhance what they're already doing.
This is the St. Louis Fed M2 money supply, and I've shown this chart on a annual percentage change basis. So it's growing at according to the latest data that came out in November, it's growing at 4.2%. So it is on the rise. Dana, have you noticed in the past a correlation between the growth of the M2 money supply versus CapEx spending from companies? Are they related, do you think?
I don't think so, because most companies aren't buying and doing things in cash. They're usually going to the market to get capital, and so in capital is private essentially. But also over the last few years, capital, at least in the U.S. and even in places like China, has come from the government in terms of industrial policies and also deregulation. So I'm not sure it's so much the supply of money, but the access to credit.
Well, how would you rate the access to credit this year versus last, especially given a more dovish Fed? We think it's going to be a more dovish Fed.
For companies, it really depends on what type of company you are and what industry you're in, because that'll determine whether or not you're going to be lent any credit. Also, it depends on what exactly you're investing in. And certainly with the Fed lowering interest rates, that does help with the cost of capital. And that's quite material, I would say, for smaller businesses who are more likely using credit cards to finance their operations and their investments. But larger firms, again, they're going to go to private capital. And again, it's whether or not you're in a hot industry or not. And oftentimes that capital may not be benchmarked off of the Fed funds rate or, stacked up from the Fed funds rate, but reflect what's going on in longer dated Treasury yields. And we know that Treasury yields have been high and elevated. And certainly we saw various gyrations last year, and we're seeing it again this year. But in general, going forward, Treasury yields are just going to be higher because we continue to have outsized debt in the U.S. and we continue to spend and cut taxes, and those all contribute to further debt going along. And investors, so far, they're still keen to purchase U.S. Treasuries because there are limited options elsewhere. But every time we have some kind of conflagration in terms of a shutdown or butting up against the debt ceiling, investors lose confidence, and that drives up Treasury yields, and that impacts corporate debt, or at least the yields at which corporations are going to have to face when they get funding.
Mm-hmm. Well, speaking of confidence, this is the Consumer Confidence Index that the Conference Board has put out. Any relationship here between the confidence index of the consumer versus the confidence index or the confidence level overall of the C-level executive, first of all?
Yes. For the most part, they're consistent in terms of falling over the last year.
Yeah.
And also just being concerned not only about current conditions, but the future. The interesting thing about businesses or CEOs of large firms is that for most of the time, they will say, okay, the economy is looking soft. We're concerned about it. But then when you ask them about their own industries, they're like, oh, well, we're fine. But we saw a shift in that confidence level and where they were less optimistic about their own industries going forward. And amid that, they are just kind of remaining on the sidelines. They're not looking to really hire people. Labor shortages and finding the right person skills is preventing them from letting go people, just kind of sticking with what they have. And also when it comes to investments, if they already plan to invest in something in the past, they're just going the course. But there's no indication that they're going to invest more, and then there was some indication that they're going to invest less.
So how much of these indices actually become a self-fulfilling prophecy? So in the case of the consumer, for example, if they're less confident, does that actually mean in a couple of months they will spend less or travel less, whatever the case may be? And for the case of, in the case of the CEO, if they're less confident in their own sector, how much of that means they're actually going to hire less, spend less, and perhaps even perform worse than they were when they were feeling more confident before?
Sure. Let's first start with the consumer. Yeah. Consumers can feel one way and do something else. And so even though consumer confidence has continued to flag, and within the details, they're complaining about prices and taxes, and they're also saying that we're switching to buying things that we need, not things that we want. They're still buying things. They're still spending because they're employed. And I think that's why we didn't go into recession over the last few years, because even though prices were rising aggressively, and after those big price increases, those changes, the level of prices are high, they still have income, and because they're working. And so as long as consumers have jobs, they may complain, but they will continue to consume, even if the composition of spending changes. And looking at businesses, again, many businesses have the capacity to invest. They just don't want to make big investments that they haven't already planned because of the uncertainty. They don't know what's coming down the pipeline. Many of them were waiting for massive amounts of deregulation. That just doesn't happen yet. And even still, even those companies, those industries like tech and finance who did experience deregulation, now they're also getting signals from the administration that they need to participate in making the U.S. more affordable. So it's like, there's this give and take. And so I think as long as businesses don't really know what the path looks like, and there's also this regulatory and policy uncertainty, they're going to hold back unless they just feel adamant about making big investments. But again, I mentioned that CEOs are changing their business models, and those changes might be pulling back on something or holding off on something or charging forth with something else that is less dependent upon external factors like geopolitics or policies within the U.S. itself.
So third quarter 2025 GDP grew at a 4.3 annual annualized rate. Let's just finish off on your economic growth outlook. What is the Conference Board projecting for economic growth, GDP growth this year?
So yes, we've actually upgraded our GDP outlook a little bit for the United States for 2025 and 2026. The upgrades through 2026 mainly focused on the very strong Q3 data. Now, consumer spending was stronger and better than we expected. So potentially the BEA received additional data after the monthly reports. But there was also still some questions about how imports and exports and also inventories behaved that ended up really boosting the number. And we still need more data, and there probably will be revisions. But nonetheless, that was really the main change for 2025. Now, we also upgraded 2026. We think we're going to grow around 2.1%. That's a little bit slower than 2025. But again, I think a lot of that's going to reflect a faster growth later in the year, as some of the uncertainties around tariffs are addressed. And also as we see inflation, it's probably going to rise a little bit in the first half, but then kind of cool off later on. And plus we anticipate that businesses will, start investing again, certainly as many of the uncertainties that we've already talked about kind of fade.
Yeah. All right. Finally, Dana, I'm just on a more personal note, curious how one can become chief economist at a firm like the Conference Board. So for the younger people watching out there who are picking career paths or interested in economics, tell us about, I don't know if there's a standard or a recommended path from college all the way to first, second job, and then eventually moving on to senior economist positions. What does that look like in 2026?
Sure. I still think there's plenty of room for economists, and especially young ones who can learn from the older ones who've lived through a few cycles. But certainly, I think certainly getting experience in different areas is important. So I started out at the Federal Reserve Board. So that's, the central bank, quasi-governmental. And then I worked on Wall Street for many, many years. So I got that private sector, client face-to-face type of experience. And then I was invited to become the chief economist at the Conference Board. And I think, having the background with being in the mix of monetary policy, but also interacting with very senior people at companies with tons of money, helped me to kind of be that person who can come into the Conference Board and not only have the perspective of Wall Street, but also to have a perspective of what's really important for CEOs of very large companies, multinationals, and also their C-suites.
Does it really matter what students study in university to prepare? I mean, is it more of a math or STEM focus or economics focus that employers care about these days?
So absolutely, you need the theory, but you also need technical experience coding. So computer science is very important. And also, I think hands-on experience, certainly interning at an economics shop or even in a strategy shop where you can learn how to watch the data, how to monitor economies, what to look for, what to expect in order to have that instinct, because it's not all about numbers and models. It's also about judgment, and having that good judgment takes time to hone, but it's so exciting when you have that.
All right, excellent. Thanks so much, Dana. And we'll catch up next time. Appreciate your insights and your updates for us. Where can we follow you and your work?
Absolutely. tcb.org.
Okay, we'll put the link down below. So make sure to follow the Conference Board there. Appreciate it once again, Dana. Take care for now.
Thank you.
Thank you for watching. Don't forget to like, subscribe.